Continuing with material on the code and unit trusts and mutual funds as part of topic 3, paper 6, we were looking at ongoing requirements of a scheme being authorised by the SFC, and we saw that under 3.4.1, changes to any scheme documentation require the prior approval of the SFC. And continuing the ongoing requirements, valuation and pricing of a scheme. This material sometimes comes up, it's very detailed. Well, let's have a quick look. The offer, redemption price, buying, selling, net asset value divided by the number of shares or units outstanding less any fees or charges. Fine. Different types of scheme assets may require different valuation policies and procedures. And these policies and procedures should be established by the management company with consultation with the trustee custodian, seek to detect, prevent, correct pricing errors, be consistently applied, be periodically reviewed by the management company to ensure they remain appropriate, and be reviewed and tested annually by a competent independent person, for example, independent auditor. Frequency of valuing scheme assets must be disclosed in the offering document, cannot be less frequent than the dealing days. If the management company is to make a fair value adjustment, it must act in good faith, exercise due skill, care and diligence, consult with the trustee custodian. We're then told unquoted shares must be valued regularly by a professional person approved by the trustee custodian. Offer and redemption prices of, or the net asset values, I should say, must be made public, free of charge, on every dealing day in an appropriate manner, such as newspapers, telephone hotlines, websites. That has been examined, be aware of that. The prices or net asset values being made public. Pricing errors should be corrected as soon as possible. The SFC must be informed if the error is 0.5% or more of the net asset value. Investors should be compensated if total loss to individual investors is more than 100 Hong Kong dollars. That's not a lot of money. And management company must bear any loss that it suffers. It cannot pass it on to the fund. Now, valuation and pricing was dealt with in the Fund Manager Code of Conduct, and here it's being dealt with in the Code and Unit Trust mutual funds. To be honest, they may not make a distinction as to the source of the material and valuation pricing. If it was to come up, it'd be one question. Now, dealing, yes, I would be aware under dealing that the regular dealing must be available at least 1 day per month. That is, you can get in or out of the scheme at least 1 day per month. Offer price quoted must be maximum purchase price. The redemption must be the net price receivable, and redemption money must be received within 1 month of application. That is very, very practical information if you are an investor in collective investment schemes. Then we have material on the suspension of dealing and deferral of dealing, and in your own time, read through that. Again, very important if you're investing in a collective investment scheme. 3.4.4, again, on an ongoing basis, the financial statements and reports that must be provided. The annual financial statements must be issued within 4 months of the financial year end, very standard, and interim financial statements must be distributed within 2 months of the period to which they relate. Then the fees for collective investment schemes on an ongoing basis. Base of calculation must be disclosed, percentage expressed on a per annum basis, and I'll leave you to read the other points there, but I'd be aware of basis for fees. Now, 3.4.6, transactions with connected persons. They must be at arm's length. The annual report must disclose must disclose details of such transactions. Third point there, any cash deposited with a trustee custodian, the management company, investment advisor, or a connected person must earn interest at commercial rates. Okay, the brokers, dealers, there's a point that I've been referring to through the material already, and here it is, and this one I think is significant. Management company or its connected person should not retain cash or other rebates from brokers or dealers in return for directing business to them. So cash rebates generally are allowed, especially with discretionary account management, but this is the one case you cannot retain cash or other rebates from brokers or dealers. It's where you are managing a collective investment scheme. Remember, that's the material that we're covering here. Soft dollar rebates, are they allowed? Yes, if there are benefit to the holders of the collective investment scheme. Unacceptable soft dollar rebates, unacceptable. We've seen that material previously and it's summarized in the table on page 23. 3.4.7 covers the issue of withdrawing authorization. This is the SFC, withdrawing authorization for a collective investment scheme. If that occurs, the management company must give 3 months' notice to the holders of the intention not to maintain authorization. Notice must be approved by the SFC that you send out to the holders of the schemes, and there's certain things that must be stated in the notice. The SFC may withdraw authorization if information in the application was false, misleading at the time of the application, any of the conditions imposed with the authorization are not complied with, desirable to withdraw if it protects the interest of the invested public. So if things are not going right, if the SFC are not happy either with the information you've provided or what you've done subsequent to authorization, then they can withdraw the authorization. Right, we now move on to the next section. Now, you will have picked up by this point that topic 3 of paper 6, there is a lot of information. It is the most examined topic at paper 6. So the material that we've done up to this point, the Fund Manager Code of Conduct and details of the Code and Unit Trusts and Mutual Funds, yes, but no way will it all be examined because there's just so much of it. And that is just as applicable to section 4. Let's look at the bullet point to start, and then I'm going to take you through the headings, because as you will appreciate in a moment, I'm not going to sit and read through all these points. It is mind-numbing, but I will give you general guidance as to what you should be focusing on. Top point, page 25 says, investments held by collective investment scheme should be sufficiently liquid. That is so important, because if people want out of a scheme quickly, you've got to find the money from somewhere. That is convertible into cash at a reasonable cost within a short period of time so that the scheme can meet redemption requests and payment obligations. Okay, so that's an overriding issue. Now, 4.1 looks at the core requirements for authorized collective investment schemes. This is general. We are going to look at specialized schemes in a moment, but this is more the big picture. Spread of investments. This is to ensure diversification and to reduce the concentration risk. And you will see all the conditions, greater than 10%, greater than 15%, you cannot hold, etc., etc. Split up into the spread of investments. The last bullet point under spread, I will emphasize. Investments of collective investment scheme and wholly owned investment subsidiaries should be added together to apply the percentages that you can see in that set of points. Government and other public securities, there is core requirements, investment in other collective investment schemes, financial derivative investments, there's conditions, and then other limitations. The other limitations I will pick out because there's always seems to be at least one of them in the exam. A scheme is prohibited from investing in physical commodities, so gold, oil, etc. Investing in any interest in real estate, you can invest in real estate companies and REITs. Any transaction involving unlimited liability is not allowed, so you cannot take on unlimited liability. Any naked or uncovered short selling is not permitted. Any security to be short sold must be actively traded on a market where short selling is permitted. That has come up. Liability of a scheme for short selling may not exceed 10% of more than 10% of total net asset value, and liability of holders must be limited to their investments in the scheme. That's fairly standard. Continuing the other limitations, schemes must not acquire securities in an entity where any individual director or officer of management company of the scheme owns more than 0.5% total nominal amount of all issued shares of that class. And scheme must not acquire securities in an entity where directors officers combined of the management company own more than 5% of the securities. So that's that would be introducing a conflict of interest between directors, officers of the scheme and the companies they're investing in. Scheme must not own securities with uncalled amounts not covered by freely available cash in scheme assets. Now, what happens is it's not that common, but you can have shares issued by a company, let's say $1 shares, and they call in 50 cents. And they will possibly call in the other 50 cents at some future date. So a scheme cannot own securities where there are uncalled amounts and they're not those uncalled amounts are not covered by freely available cash. Scheme may not borrow more than 10% of net asset value. There's no limit on back-to-back borrowings. Scheme must maintain at least 100% collateralization when engaging in securities margin financing. That's fairly reasonable. Scheme must invest 70% of non-cash assets in relevant investment category if name identifies particular objective, geographic location, or market. So if it's a Japanese technology fund, then at least 75% of the non-cash assets have got to be in Japanese technology companies. That's what they're referring to there. And any breach of all these requirements should be rectified within a reasonable time. So I've gone into those points in a certain amount of detail simply because I've seen one or two of them pop up in exams over the years. So I would tick those off on your list.